Hello, everyone. Welcome to Crypto Unlocked. I'm your host, Crypto Daryl, and today I can already sense that in 2025, it's shaping up to be a wild ride for investors. Just look at the past few weeks. Artificial intelligence is facing heat from China. New tariffs have triggered rapid retaliation and market chaos, leading to sell-offs. Meanwhile, the housing market is finally starting to tilt towards the favor of buyers. While the last few years have been incredibly lucrative for those who have stayed invested, 2025 throws some curveballs that might seriously impact your gains or losses. So let's dive into that in my exact investing plan for the rest of 2025, what history suggests to likely happen in the stocks, real estate, and crypto, the red flags to watch for, and most importantly, how you can maximize your income. Most importantly, how you can maximize your chances of coming out ahead. Hit that like button and subscribe, and let's get started. What makes 2025 so different from 2024 is a sharp shift in political conditions. In just a few weeks, dozens of executive orders have been signed in by Donald Trump, giving regulators free rein to overhaul entire industries. Banks can now hold cryptocurrency, which is amazing, on their balance sheets without labeling them as liabilities. The IRS is scaling back, which might mean lower taxes, and there's even a bill floating around to eliminate income tax entirely. Yes, really, entirely. While the market has riled on this wave of optimism, the harsh reality is that the U.S. is still drowning in debt, heading toward yet another financial cliff. New tariffs could disrupt the economy in the short term. The Buffett indicator is at higher levels than before the dot-com crash. And UBS warns that 6 out of 7 conditions for a stock market bubble are already met. Investors are left wondering, how much higher can this go? And could a major sell-off be coming? This adds a layer of confusion because while conditions favor investors, prices don't climb forever without hiccups. Let's break this down starting with stock market. Studies have shown that the average American is terrible at investing. Most barely beat inflation. If you don't understand the basics, you won't know what to watch for. A 2014 Business Insider article highlighted why so many investors underperform despite rising asset prices. The S&P 500 had dropped around $1,800, a golden century point in hindsight, yet many investors cashed out and sat on the sidelines, missing some of the decade's best months. Missing just the 40 best days over 20 years can tank your returns because those gains can't compound over time. Interestingly, the best days often follow the worst, and fund flow data shows investors tend to buy high when the market peaks and sell low near the bottom, which is absolutely an amateur move. So what does this mean for 2025 though? Most analysts are bullish. Morgan Stanley, JP Morgan, and Goldman Sachs predict that the S&P 500 will hit 6,500 by year's end, while Oppenheimer's see a 20% rise, potentially reaching even higher. The market just had its best 2 years run in its 25-year history, but that's no guarantee. Trump's policies could boost spending and profits, ushering in an economic boom. But tariffs pose a downside risk, slowing growth, reigniting inflation, and triggering the sell-off as we're seeing right now. Trump recently slapped a 25% tariff on goods from Mexico and Canada, 10% tariff on China with the retaliation clause. If they counter with their own tariffs, ours go even higher. Mexico responded by deploying its National Guard to the border, while Canada imposed tariffs on U.S. products, leaving room for escalation. This could lead to a 1.2% GDP loss and a stock market dip, or it might be a brilliant negotiation tactic if Mexico secures the border and avoids tariffs for another 30 days. That's why I treat the stock market as a long-term investment. I won't touch something of this nature until it's 20 to 30 years out. Short-term fluctuations don't faze me, and history shows staying invested pays off. The S&P 500's rolling 20-year returns have never lost money in the past century. The worst annualized return was just under 4%, starting in 1948, while the best was over 16% starting in 2001. Most years averaged 7 to 10%, with low years balanced by high ones. In the short term, anything can happen. Your odds of profit are 73% in year 1, 80% in year 2, 90% in year 5, and 97% in year 10. The longer you stay in, the better your chances. But as 2020 taught us, unexpected events can strike. UBS notes that 6 out of 7 bubble conditions are met. Stocks outperforming bonds by 5% over 10 years, slowing earnings growth, lack of S&P 500 diversification, 25 years since the last bubble. This time is different mindset and a retail participation. The only thing missing is loose monetary policy, giving a 35% chance of a bubble. I stick to dollar cost averaging into the market regularly, regardless of the price, because I can't predict the future. If a sell-off hits, a long time horizon lets me buy in at a discount. Now, let's talk about real estate. It's a little bit different of a beast, especially if you want to come out ahead. Housing can be brutally competitive and expensive since 2020, especially. Low interest rates locked in homeowners, and an inventory shortage kept prices high, and recent rate hikes crushed affordability. Trump claims he can lower home buying costs through a new executive order, pointing to regulations that account for 25% of new home construction costs, 23.8% for single-family homes, and 40.6% for multifamily per studies. Now, but critics argue his tariffs could backfire, raising lumber costs from Canada by 25% and increasing labor costs if deportations reduce the immigrant workforce many builders rely on. The U.S. faces a housing deficit of 2.5 to 7.2 million homes per Realtor.com. So construction needs a massive boost to make a dent. Federal regulations are just one piece of the puzzle. Even if building costs drop by 20% by cutting rules like energy efficiency, it won't happen in the next 12 to 24 months. Home prices are still 50% higher than in 2020. Especially with mortgage rates at all-time highs. Trump's orders lack specifics on where to cut costs beyond regulatory requirements, which often fall to states and cities to ensure developers don't cut corners. He's mentioned using federal land for housing, but most of it isn't near desirable areas or job hubs, making it a tough sell. Now, to improve affordability without political fluff, I see a few practical steps. First, let homeowners take their existing loan and interest rates to their next house. If you've got a 3% on a $500,000 balance, you should be able to apply that to your next home. This would unstick sellers, encouraging them to move. Second, allow homeowners to transfer their property tax basis when moving nearby. If you bought a home in 2017 with a $600,000 tax basis, it's now worth $1.2 million. You would pay $7,500 in taxes annually, but at market value, it would be $15,000. This keeps people from listing as moving spikes their cost. Third, cut capital gains taxes on primary residence sales. Some longtime owners face up to 37% in taxes on gains. Imagine buying a home for $100,000 in 1970 that's now worth $3 million. Even with a $500,000 exclusion, that's $800,000 in taxes. Fourth, adjust the capital gains exclusion for inflation. In 1997, you could keep $250,000 single or $500,000 married tax-free. Back then, the median home price was $124,000 versus $460,000 that it is today. Adjusted for inflation, that exclusion should be around $1 million. Finally, offer tax credits or subsidized interest rates to builders. If builders face lower taxes or get incentives, they'll build more, including affordable units. It's all about financial motivation. For 2025, my real estate advice is to only buy a home you can afford and plan to keep for the next 10 years. Otherwise, renting is the cheaper option in most areas. Personally, I haven't found a good real estate deal lately. But lastly, let's tackle the main issue, crypto, the most controversial topic. Bitcoin and the broader market have surged since Trump's election, and a new rule could drive even more demand. Previously, banks holding Bitcoin had to list as a liability due to the volatility and theft risks, deterring them from touching it. But on January 24th, the SEC reversed this. Okay, allowing banks to custody digital assets without the liability tag. It's early, but I'm optimistic more banks might embrace crypto over time. There's also buzz about the U.S. creating a Bitcoin stockpile, which would cement its value. The current executive order is vague, mentioning only an evaluation of the national digital asset stockpile from seized current cryptocurrencies, not a direct purchase of 2.1 million Bitcoin. Still, it opens the door for the future demand. Now, analysts are mostly bullish on Bitcoin price. CoinShares predict $80,000 to $150,000 by year end. Galaxy Digital sees 185,000. Bit Mining and Maple Finance I see 200,000 and Nexo's at 250,000. I've been dollar cost averaging Bitcoin ETFs for over a year. Riding the ups and downs has worked well, but I'm prepared to lose it all if things go south. Long term, I'm bullish. ETFs make it easy to invest without self-custody worries. And I think more people will diversify into Bitcoin, pushing prices up. But I could be wrong. Now, we'll see how this goes over the next decade. My 2025 investing blueprint is straightforward. I'm setting aside a fixed amount monthly to invest no matter what. I'm diversifying 75% into the S&P 500, 15% in international equities, and 10% into a Bitcoin ETF. I won't sell for the next 10 to 20 years, so short-term dips really don't matter. Finally, I'm sticking to a plan, and this plan is on autopilot, letting compound interest do its work. It's like magic. That's how I'm navigating a Trump economy in 2025. What do you think, though? Drop your thoughts below, and I'll read the comments. I'll check them out. And I want to see who actually thinks a little bit differently. Am I completely wrong? Is your portfolio only one crypto or is it completely diversified? Hit that like button and subscribe. And if you haven't already, make sure you comment down below. And I appreciate you. And I will see you on the next week.